This episode is brought to you in association with Janus Henderson Investors. It's for promotional purposes only, is not for forward distribution, and the value of an investment can fall as well as rise. Past performance is not a guide to future performance, and nothing in this episode should be construed as advice. Our discussion is for illustrative purposes only, and references made to individual securities should not constitute or form part of any offer or solicitation to issue, sell, subscribe, or purchase the security. Hello, and welcome to Trust Radio, the investment trust podcast hosted by Janus Henderson Investors, where we take a deep dive into the questions investors really want to know the answers to. Hello, my name is Andrew Chiguri, and today I'm joined by John Bennett and Tom O'Hara to talk about factors currently affecting the European market and how they're navigating some of these challenges. After a relatively calm 2021, 2022 has brought with it new challenges that have forced investors to rethink their positioning. In 2020, you bought into the industrial V-shape, but in 2021, you bought into the consumer V-shape. How are you navigating 2022 at the moment?
In terms of navigating 2022 to date, there's probably three things that have come in to hit markets and indeed economies, in my view, that we've had to take account of, and we have adjusted the portfolio partly in response to that. First, of course, you've had the ongoing, and I think probably yet to intensify, squeeze on consumer wallets. So the cost of living crisis, which, notwithstanding political rhetoric, is not unique to this country. It's a global phenomenon. Such is the nature of inflation. And of course, then the second event was the tragic situation which continues to unfold in Ukraine. Various implications there. Always hard to try and distill that into financial and economic implications, given that there are very real life human implications as well, for human realities. But if we do just look at some of the financial and or economic implications, clearly we think it is inflationary as well, not least in food markets, given the importance of Ukraine to wheat markets, cooking oil and other markets. And then the third thing, which who knows how this plays out, but the Chinese trying to aim for zero COVID. And that too has implications for supply chains. So we've had to deal with dislocations to supply chains. We've had to deal with, and the economy, what I mean is the economies globally are having to deal with supply chain disruption, supply chain inflation in intermediate goods, capital goods, and the consumers having to deal with inflation. So it's a bit of a perfect storm, and which is of course why markets, in my view, what markets are doing right now is trying to price that in. Is probably trying to price in two things. And one is easier to price than the other. One, it's easier to price in recession. You just drive share prices down to a level where it's discounted. And in Europe, we are approaching that level. But it's hard to price in inflation because inflation's behavioral by nature. It's a genie that's out of the bottle, and it's very, very difficult for central bankers, policymakers to get that genie back in the bottle. So recessions come and go. We probably will get a recession in large parts of the world in the near term. It will disappear again. We will come out of it. The bigger one for me is inflation. Do we head into stagflation? That's a question, not a forecast.
In such a difficult market environment, what changes have you made to the trust? Are there any areas you've added to or divested from?
Yeah, we've had to moderate that consumer V-shape that we became exposed to in 2021. And initially we decided that we would moderate away from mass market. So we divested things like Inditex, things like Adidas. We took the view that travel would be resilient. And so that was an area that we decided to retain our focus. But actually that recently as well, we've decided to ease off that as we've seen massive disruption in airports, as we've seen fuel prices go higher. It does leave the question that this summer, which from a demand perspective should be incredibly strong. I mean, there's probably been no summer in history in which people have been more gagging to get away on holiday. But actually, whether the system can deliver that in a seamless fashion and in a way that delivers enhanced profitability to the airlines, to the ecosystem around that, well, we've got a few more questions about that now. So we've been easing off there in conjunction with what John mentioned about the hit to the consumer wallet. The consumer's still calibrating this as well. This is an ongoing process, and this is one of the question marks for the remainder of 2022. When does consumer sentiment trough, really? Well, we're still going through a process of the consumer probably, at least initially, having been in a state of denial about it because energy bills hadn't quite hit, and they still haven't quite hit, to realizing that monthly energy bill, the monthly cost of filling up the car tank, those are actually really starting to bite. So that's where we've moderated since 2021, that consumer V-shape. And in terms of what we've added, well, it's been quite a mixed bag, hasn't it, so far? We've very much stuck to our agnostic approach. We don't go ever all out growth. We don't go all out value ever. And actually 2 recent additions to the trust illustrate that quite well. So we've added Bayer, which for a long time now has been a pretty classic troubled value stock, not least because of the litigation it's faced in the US following its acquisition of Monsanto. The second stock that we've added recently, more in the growth sphere, very much a quality company, not one you would expect to lose much sleep over at night, is Universal Music Group. Bayer and Universal Music Group couldn't really get 2 different stocks. That's the way we're navigating things at the minute. Very, very stock specific, value, growth, style agnostic, as always.
You touched on it slightly there, that you're style agnostic, meaning that you hold a blend of both value and growth. Has this helped you navigate the volatility we're seeing in equity markets at the moment, particularly within that growth element of the portfolio?
Volatility has never really fazed me. It's these are risk assets, equities are risk assets, and therefore volatility will come in and go. You get bouts of it. I think one of the gigantic mistakes that was made by investors yet again, and I have to say the retail investor unfortunately tends to be a bit of pay a heavy price for this kind of thing. The retail investor is not unique in paying the heavy price. Institutional investors do so too. But there was almost a belief, nothing in life is linear. Is linear the, at least conceptually, the opposite of volatility. But there was a belief in recent times, and I saw it in the previous bubble for technology stocks, 99, 2000. There was a belief that technology stocks, disruptor names, sustainability darlings, they were linear. They were the next generation's or this generation's only avenue, only outlet for savings. And that extreme positioning towards growth stocks, many of which had no cash flow or very little cash flow, that's what we avoid. When we say that we're blend, we're agnostic, we don't, I've always, a very simplistic analogy and maybe too simplistic, but I don't want to be caught all one side of the boat when the wind turns, because then I can get flipped, I can get capsized. And I'm not even a sailor, so it's probably a useless analogy, but I just don't want to have a portfolio that requires a set of circumstances to play out. What you had in technology, exacerbated by this, and I said it at the time and I will repeat it, this mad dash for ESG labelled strategies, and it's the label, it might not be the reality, but it's certainly been labels, was you had this dash for growth stocks, which were already expensive. I'm a great believer that linear doesn't work. It does for a while. Extrapolation works for a while, but then reality comes in and it's called mean reversion. It's called cyclicality. Cycles apply to everything in life, in nature, and in the nature of investing. And and one thing it applies to cyclicality is the capital cycle. This is a really important point. In the capital cycle, and the capital cycle that we've just had play out and that is now unwinding, and I think we're in the relatively early stages of this unwind, capital becomes cheap and easy and then free. And it did via the venture capital industry for a whole host of tech companies, listed and unlisted. And it flooded in to a whole host of listed and unlisted companies. It re-rated the listed to multiples that became exorbitant. And it enabled startups and similarly early stage wannabe tech disruptors to come in and compete in those areas that were already overpriced. I've seen this movie before. And when you have an influx of capital to that extent, then other areas of the market get starved of capital. We were being a bit flippant earlier on, talking about what might drive us into oil stocks or resources stocks, capital to starvation. They went through the opposite side of the capital cycle. They were starved of capital as fund managers, including perhaps ourselves from time to time, felt pressure to disown whole sectors. No, we mustn't do that. We must not do that in the name of ESG labelling. And that's what's happened. You've had capital starvation from areas of the market that therefore never had a bull market, energy, resources, and a capital surge into areas that became ridiculously overvalued. And again, I think a whole host of retail and institutional investors are at the very beginning of experiencing the pain of being in wildly overvalued portfolios of stocks called growth funds. That movie has not yet reached its conclusion. I think we are in the foothills of a whopping bear market for the growth style.
Though the trust has held up relatively well, the discount remains quite wide compared to the sector. What do you think is driving that sentiment at the moment?
The trust is trading at a double-digit discount at the minute. And I think that the vast majority of that is down to Europe, demand for Europe. It's interesting, earlier in the year, we had quite a monstrous value rotation right up until the Russians invaded Ukraine. And during that period, it was one of the strongest periods of interest in Europe that we'd seen for quite some time, because Europe is regarded by global asset allocators as a value construct. So if you're a US-based global asset allocator and you've been over 2/3 US, and that's been wonderful because it's been growth stocks making out. If you start to see signs of a value rotation and you have the option to asset allocate elsewhere in the world, you will look at Japan, you will look at Europe. And we noted that, a leading indicator for us is requests for client meetings. And we got a lot of those during that value rotation. Europe came back into fashion because Europe holds a lot of the companies that should outperform when value outperforms growth. And then the war started and we saw all of that fade. So it's really, I think, a case of Europe not being very fashionable once again. It is, after all, technically a war zone now as well. So if you don't have to invest in Europe at this time, when you've already got enough challenging things or challenging situations to deal with, whether that's China's COVID policy, whether it's when the Fed starts to blink, whether it's supply chain disruption, then you may just take the decision not to invest in Europe. And I think that's where we are. But ultimately, that's what creates opportunity.
You both touched on inflation there. And I think most investors are betting that inflation will peak at the second half of 2022. However, certain aspects of the economy, for example, wages, energy prices, and increased capex spending from companies, point to a sustained period of high inflation. How are you positioned to cope with a prolonged period of higher inflation?
I think you've actually nailed it there just at the beginning of that question, which is most investors expect that inflation, is peaking now or peaks very soon and sort of seems to wash out and come on back in, the water's warm, and we can all stay safely in our growth stocks. I think that's a major reason why investors, institutional investors, retail investors, have not thrown in the towel. This is not how these situations end. These situations end. You've seen it with the value style. People throw in the towel. They think it's all over. It's gone. And never again will I touch a value fund kind of thing plays out. I believe that's coming to growth. And the reason it's coming to growth, in my view, is in your question, is I don't think inflation is transitory. I mean, we can, laugh with some sadness, in a sense, laugh that there were people saying this is transitory, and then they would say, "Oh, it's just transitory for longer." I remember that phrase being bandied out. This is called hope. It's about like people buying the dips. They learn not to buy the dips because they've caught so many falling knives that they've been lacerated. So you tend to find that before a cycle, especially a bubble that deflates, and I think we had a bubble in the likes of the NASDAQ and in venture capital tech in general, you tend to find that well-known figures in those asset classes, and I'll use a euphemism here, retire. So you saw it with value managers going way back. I remember it in the late 1990s. Famed value managers retired and or were sacked. And I would expect, for example, I've never met the lady, but I would expect that before this is over, Cathy Wood is doing something else. It's how it plays out. So we're nowhere near that yet, but I think we will get there. In terms of how we are set up, inflation is, first and foremost, inflation is the enemy of not only bonds, but assets, equities that price off bonds. In other words, long duration assets. And that means growth stocks. So you make sure that your multiples in your portfolio are not too high. And we've always tried to be very disciplined when it comes to valuation. We also want to make sure we've got sufficient resources, and there's a very live discussion between Tom and myself, the rest of the team. Do we have sufficient real assets, energy, resources? And they can be found in the likes of the utilities as well, incidentally, albeit they come with a wealth warning because you're getting closer to governments when you buy utilities. But there are situations like RWE in Germany, for example, which is effectively going to break up, split to become a clean utility and a less clean utility, and some of the less clean assets such as lignite, they go into government hands and go into runoff. That's a perfect ESG transition story as far as I'm concerned, but you get it at a value multiple because it's not pure renewables. That's how we're trying to navigate this. Without owning farmland, which we can't buy, physical farmland or other traditional hedges against inflation such as forestry or physical gold or physical oil, we've just got to make sure, A, the multiple of that portfolio is not at the mercy of inflation like most growth stocks are, and B, we have sufficient hedges and indeed inflation beneficiaries.
Probably worth pointing out here that we've got 7% of the fund in oil stocks, we've got 5% in utilities. So in terms of exposure to important parts of the toolkit for a fund manager, for an equity fund manager to tackle inflation, we've got 12% of the fund, about 300 basis points overweight in energy. So whether that's oil, gas, renewable energy, electricity, that should be quite a big hedge against an inflationary environment.
One of the consequences of higher inflation and energy prices is that consumers have less disposable income and are currently going through a cost of living crisis. Now, in that scenario, it makes sense to be overweight consumer staples. However, the trust is also overweight to the consumer discretionary sector, which could suffer from lower consumer spending. What's driving this overweight to the consumer discretionary sector?
It was, two things. It was more overweight than it is now, only a few months ago, and it was down to the factor that Tom explained earlier, that we had actually reduced through the mass market names, but we'd tailored it to what Tom talked about earlier, travel. We've actually paired quite a bit, even in recent weeks. So even favoured names like Hugo Boss, self-help, Pandora, self-help. We may well still believe in those self-help stories, but we do think that the pressures you've just talked about facing the consumer are such that something must give. So we've actually been tailoring that down or tapering that down, that exposure in recent days and weeks in consumer discretionary. So I wouldn't be surprised to see negligible, if any, overweight to consumer discretionary in the coming days and weeks. Staples is an interesting one because our biggest active position in staples is actually a commodity, and it's called salmon. the salmon farming business Mowi, based in Norway. The environmental optics of that are distressing not only to myself as a keen fisherman, but to the rest of the world in terms of the detritus, the waste, the sea lice effects of that industry. But one of the reasons we're there is the growth in demand for that source of protein called salmon, and that source of protein is also cleaner and greener than red meat, for example. So you have to have alternatives. And then the other reason is we're invested in the leader, Mowi, and that company has the cash flow, the balance sheet, the financial firepower to find the solutions to those environmental challenges. I don't believe it's for us to cancel all sorts of companies and industries if we can see a delta, if we can see positive change. The technology to fix so many of today's ESG, really the E of the ESG, the environmental challenges, it rests within so-called old economy or old economy companies. The technology, the technicians, the skills, they rest within these companies. So even in staples, it's not one size fits all. Nestle is a holding for us. We're not overweight the name, but even Nestle is going to feel the effects of input cost inflation. Even Nestle, I think, may well feel the cost of a challenged consumer trading down. So safety is not all it's cracked up to be. There is perceived safety, and people can flock to that safety, but they end up in flocking, overpaying for something that could easily warn or could easily disappoint earnings because of the pressures. I think in general, what you're going to see in the coming months is a severe margin squeeze on all sorts of companies, almost regardless of sector.
I think that's a really good point. We're just starting to see it now. What's been interesting year to date is for many companies updating at Q1, not many warnings. Most companies coming out saying the consumer's still resilient, demand is still fantastic, we're passing it through, margins are fine. And in recent days, we're just starting to see a few more companies wobble, aren't we? So we've had it in the UK consumer sphere. We've had DFS. We've had some other companies close to the consumer saying, actually, things have just changed quite quickly. They didn't quite see it coming, and that's the point. In a lot of these businesses, you don't always get fantastic visibility. You don't see it coming down the track months away. So sometimes these management teams are no better informed than you and I. So they suddenly have to come out and say, "Oh, we've just noticed it in the last couple of weeks," and then the market cottons on and goes, "Right, there's a problem here." Yeah.
You're going to see and hear a lot of companies talk about June, the month of June. They're going to say it happened in June. As Tom said, it the last couple of weeks, it started in June. I mean, I've been hearing about a clothing retailer in the US, not listed, not up market at all. And as always, they said, and this is me getting it third hand, but it was along the lines of, well, the 1st of June came along and it just stopped. The consumer just froze. So I'm not extrapolating that to absolutely every company, even in that sector, but you're going to hear much more of that, whether it's input costs for the manufacturing sector via inflation and supply chain challenges, and a challenged consumer. Profit warnings are coming. And I'm ever so sorry to pick on growth stocks, but when you are on 28 to 38 times earnings and you don't make the numbers, you get the double whammy of the earnings downgrade and the PE contraction, the multiple contraction. And we're sailing right into those waters.
Maybe it's a little bit about, we talked about it earlier, consumer denial turning into consumer realization. And as John said, June, we've just come off the back of Jubilee celebrations, people going on holiday, many people having a pretty crappy and expensive experience with their holiday, and then coming back and facing new bills and higher costs, over 100 quid to fill your car tank up now. The consumer realization is starting to come as well, and that's going to feed into this.
Speaking to John specifically here, I think the topic that's gaining momentum at the moment is stagflation, which is something that was last seen in the 1970s. What are the similarities and differences between the 70s and now? And what lessons can investors glean from this period to navigate such an environment?
It's horrible. I mean, I'm unlike Tom, I am old enough to remember the 70s, but I was not old enough to be an investor. And even if I had been, I was completely skint. I had no money to invest. But it's really difficult to navigate stagflation in financial assets because you don't want to be in bonds because of the inflation erosion of the coupon. Some equities will help you. Real assets will help you. Real assets or paper claims on those real assets, be that forestry, agriculture. And one of the reasons we're in Bayer, for example, is its exposure to agriculture markets. You might want to, believe it or not, to tilt your portfolio towards government largesse, because government largesse will continue, especially if they try to turn on fiscal taps. So, for example, you're getting a transfer of wealth towards renewables right now. That will probably continue. So there are areas that you can tilt a portfolio to. Now, you probably haven't heard me say this before, but you don't want to be in growth stocks.
Now, the war in Ukraine has disrupted global energy markets. However, this is particularly acute in Europe, which is heavily dependent on Russian supply. How can the continent balance the need to transition between cleaner energy sources whilst ensuring that the energy supply is secure?
I mean, I think it's taken a few things. COVID, to an extent, China, and the draconian measures there as a result of COVID, or in response to COVID. And of course, what you've just said, you've just mentioned the war in Ukraine. I think it's sadly taken these events to provide the biggest alarm call, wake-up call to the ESG maniacs, the ESG fervour brigade. In other words, the cancellation culture. The madness of cancellation culture came to the corporate world, came to whole industries. We were told any defence stock is off limits. And then the same people were saying to us, well, they're actually really, really good for the S of ESG because Putin's invaded Ukraine and we need to save these people. You can't just flick a switch like that on your investment beliefs. I think one of the biggest frustrations to watch this has not just been the distortion of capital markets and the distortion of capital as it is applied to companies and industries, starvation of some and a surfeit of capital to others, and I talked about that earlier. The other frustration for me and my team is that we've always practiced this. We feel we've always been active and activist in the world of ESG. It's just we didn't label the funds in that way. Perhaps we weren't cynical enough in not labelling the funds, because when you called your fund sustainable and actually put growth after the word sustainable, because everybody likes growth, who buys decline? Or let's call it sustainable growth. You gathered assets.
The mad thing as well with that is a lot of this headline grabbing ESG, the more dangerous dogmatic stuff, has had an impact on the strategies of companies.
Yeah.
So you talk to Shell, an enormous global energy enabling company. It's oil, it's gas, but it's electricity, it's forecourts, it's marketing businesses. They are almost distracted at times. And I get this because whenever we meet the management team of a company in this industry, you get either their IR team or the company or the bank that organised that roadshow come to you and ask you for feedback. And they have a list of questions. So how did you find your meeting with the management team? A good 50% or more for these companies have become, how do you find their communication on their energy transition strategy? And, do you think they need to reduce their upstream supply more quickly? All of this stuff. So it's always been really alarming how a very, very purist, dogmatic end of the ESG investing spectrum has actually started to creep into how these management teams spend their time and thinking about managing their business. And arguably that's part of the shock we're now dealing with. As John mentioned earlier, starvation of capital in industries sets up the next supply-demand shock. That's where we are now, and arguably ESG has a responsibility, at least partially, in that having come about.
companies, I've always said it doesn't matter where a company has come from, where is it going? It can shed divisions. It can deploy cash flow from fossil fuels whilst running down those fossil fuels. That's called a delta, because it's deploying those cash flows in green fuels, in renewables. This has to be a winning solution for society. It's a hell of a easy to take a scorecard approach and just say, yeah, I've excluded that, look at that, please give me assets to manage. I don't think that serves anybody any good.
Well, that's all we have time for today. Tom, John, thank you for joining us.
Thank you.
Thank you.
And thank you for listening. If you enjoyed this podcast, please subscribe, rate, review, and share this with anyone you think will also find this interesting. If you want to learn more about investment trusts, we have a wealth of information available on our website, which you can find in the show notes. Important information, not for onward distribution. Before investing in an investment trust referred to in this podcast, you should satisfy yourself as to its suitability and the risks involved. You may wish to consult a financial advisor. This is a marketing communication. Please refer to the AIFMD disclosure document and the annual reports of the AIF before making any final investment decisions. Past performance does not predict future returns. The value of an investment and the income from it can fall as well as rise, and you may not get back the amount you originally invested. Tax assumptions and reliefs depend upon an investor's particular circumstances and may change if those circumstances or the law change. Nothing in this podcast is intended to or should be construed as advice. This podcast is not a recommendation to sell or purchase any investment. It does not form part of any contract for the sale or purchase of any investment. We may record telephone calls for our mutual protection, to improve customer service, and for the regulatory record keeping purposes. Issued in the UK by Janus Henderson Investors. Janus Henderson Investors is the name under which investment products and services are provided by Janus Henderson Investors International Limited. Reg number 3594615. Janus Henderson Investors UK Limited. Reg number 906355. Janus Henderson Fund Management UK Limited. Reg number 2678531. Henderson Equity Partners Limited. Reg number 2606646. Each registered in England and Wales at 201 Bishopsgate in London, EC2M 3AE, and regulated by the Financial Conduct Authority. And Henderson Management S.A. Reg number B22848 at 2 Rue de Bitbourg, L1273, Luxembourg, and regulated by the Commission de Surveillance du Secteur Financier. Janus Henderson. Knowledge Shared and Knowledge Labs are trademarks of Janus Henderson Group plc or one of its subsidiaries. Copyright Janus Henderson Group plc. Capital cycle. A business's working capital cycle is the length of time it takes to convert net working capital, like current assets and liabilities, into cash. CapEx. CapEx, known as capital expenditure, is spending on fixed assets such as buildings, machinery, equipment, and vehicles in order to increase the capacity or efficiency of a company. Cyclicality. This is companies that sell discretionary consumer items such as cars, or industries highly sensitive to changes in the economy, such as miners. The prices of equities and bonds issued by cyclical companies tend to be strongly affected by ups and downs in the overall economy when compared to non-cyclical companies. Inflation. The rate at which the prices of goods and services are rising in an economy. The CPI and RPI are two common measures. Stagflation. Stagflation is characterized by slow economic growth and relatively high unemployment or economic stagnation, which is at the same time accompanied by rising prices, i.e. inflation. Growth investing. Growth investors search for companies they believe have strong growth potential. Their earnings are expected to grow at an above average rate compared to the rest of the market, and therefore there is an expectation that their share price will increase in value. Value investing. Value investors search for companies that they believe are undervalued by the market, and therefore expect their share price to increase. One of the favored techniques is to buy companies with low price to earnings PE ratios. Volatility. The rate and extent at which the price of a portfolio, security, or index moves up and down. If the price swings up and down with large movements, it has high volatility. If the price moves more slowly and to a lesser extent, it has lower volatility. Higher volatility means the higher risk of the investment. Price to earnings, also known as PE ratio. It's a popular ratio used to value a company's shares compared to other stocks or benchmark index. It is calculated by dividing the current share price by its earnings per share.